Hi everyone, welcome to my YouTube channel which is Explore Yourselves, Banking and General Knowledge, etc. Today I will discuss about group discussion topics for related to the internal promotion examinations for bank employees. Welcome to part 17 of my Path to the Corner Office 2025-2026 series, where I will break down real bank promotion exam questions and give you clear, practical sample answers about group discussions to help you climb the career ladder faster. Discussion topics: priority sector lending, social obligations or business constraint. Introduction. Priority sector lending (PSL) refers to the policy type and mechanism by which banks and financial institutions are required to direct a certain proportion of their lending portfolio towards specific sectors deemed important for the socio-economic development of the country. These sectors typically include agriculture, micro, small and medium enterprises, SMEs, education, housing, export credit, and other categories identified by the Reserve Bank of India from time to time. PSL emerged as a crucial policy tool in India to ensure financial inclusion, reduce regional disparities, and promote social welfare. The dual nature of PSL raises an important question. Is it primarily a social obligation, reflecting the bank's responsibility toward inclusive growth, or a business constraint, limiting the bank's profitability and operational flexibility? Historical background of priority sector lending. The concept of PSL in India has evolved over decades. 1960s to 70s, the nationalizations of banks in 1969 and 1980 aimed at directing credit to neglected sectors. Banks were mandated to lend the agriculture, small industries, and low-income groups. 1990s, with economic liberalization, the focus shifted towards market-driven lending, but PSL remained a statutory requirement. 2000s onwards, RBI formalized the private sector lending guidelines, specifying targets, eligible sectors, and sub-limits. Recent changes, 2020 to 2023, introduction of digital lending, increased emphasis on green finance, and inclusion of specific subsectors like renewable energy and affordable housing. These historical developments indicate that PSL has consistently been a policy tool to balance economic growth with social equity. Regulatory framework, RBI guidelines. The Reserve Bank of India prescribes PSL norms under the Banking Regulation Act 1949. Key points include target. Scheduled commercial banks SCBs are required to lend at least 40% of their adjusted net bank credit or credit equivalent of off-balance sheet exposure to priority sectors. For domestic commercial banks, 40%. For foreign banks with less than 20 branches, 32%, and foreign banks with more than or equal to 20 branches with 40%. Sublimits within PSL. Agriculture, 18% of ANBC. Micro, small and medium enterprises, MSME, 7.5%. Weaker section, 10%. Others, export credit, education loans, housing loans, renewable energy, etc. Eligible lending categories: agriculture, crop loans, allied activities, equipment financing, micro and small enterprises, MSMEs, manufacturing, services, microcredit, educational loans to students for higher studies in India and abroad, housing loans for individuals below specific income thresholds, weaker sections, small farmers, women, scheduled castes, scheduled tribes, minorities, other categories, renewable energy, social infrastructure, export credit. Implementation mechanism. Banks achieve PSL compliance through direct lending to eligible sectors, indirect financing through financial intermediaries, NABARD, SIDBI, NHB, priority sector lending certificates, PSLCs, allow banks exceeding targets to sell excess credit to others, enabling market-based compliance. Objectives of priority sector lending. PSL is not only a regulatory obligation but also a policy instrument aimed at inclusive growth. Its objectives can be summarized as follows. Social objectives. Financial inclusion. Extend credit to rural and underbanked regions. Support to agriculture. Ensure adequate funds for crop production, irrigation, and allied activities. Poverty alleviation. Assist weaker sections and small borrowers. Encouraging entrepreneurship. Facilitate MSME growth, promoting employment generation, regional development, reduce urban-rural disparity in access to finance. Economic objectives. Credit flow to growth sectors. Agriculture and MSMEs contribute significantly to GDP and employment. Boosting exports and industry. Targeted lending supports export-oriented MSMEs. Sustainable development. Recent PSL policies promote renewable energy and environmental sustainability. Risk diversification. Through PSL often involves small ticket loans, it helps banks diversify their loan portfolio across sectors and geographies. Priority sector lending, social obligation. Arguments supporting PSL as a social obligation. Fulfilling government mandates, PSL aligns banks with national developmental goals. It reflects the social responsibility of financial institutions to contribute to inclusive growth. Equitable access to credit provides financing to sections of society that would otherwise be ignored by profit-driven commercial banks. Empowering the weak by prioritizing weaker sections, women, and small farmers, PSL promotes social equity. Long-term economic stability, inclusive growth ensures a larger tax base, increased consumption, and poverty reduction, which indirectly benefits banks. CSR integration, PSL complements corporate social responsibility initiatives, showcasing banks as responsible corporate citizens. Practical examples. Agricultural credit. Crop loans to small and marginal farmers help reduce dependence on informal money lenders charging exorbitant interest. Microfinance loans. Lending to self-help groups such as empowered women and improved rural livelihoods. Education and housing loans enable upward social mobility and contribute to national human capital formation. Implications for bank officers. Officers must evaluate the social impact of lending decisions. Understanding social priorities helps in designing bank schemes that align with PSL while ensuring repayment capability. For promotion exams, knowledge of recent RBI circulars on PSL categories and sub-limits is crucial. Priority sector lending, business constraint. While PSL has social benefits, it often presents operational and financial challenges for banks. Arguments supporting PSL as a business constraint. Low profitability, PSL loans often have lower margins than commercial loans due to interest rate caps and small ticket sizes. Higher credit risk, borrowers in agriculture, MSMEs or weaker sectors may have uncertain cash flows and higher default probabilities. Operational burden, monitoring, documentation and recovery of small loans are labor intensive and costly. Impact on capital allocation, mandated lending reduces banks' freedom to deploy capital to more profitable or lower risk sectors. Asset quality challenges. High exposure to vulnerable sectors may increase non-performing assets (NPH). Evidence from banking sector. Public sector banks often struggle to meet PSL targets without increasing operational costs. MSME loans sometimes default due to seasonal business cycles or lack of formal financial documentation. Aggressive lending to meet PSL targets may lead to misallocations of resources affecting profitability. Officer perspective for promotion exams. Understanding the trade-off between regulatory compliance and profitability is a key. Exam questions often ask candidates to propose strategies to balance PSL requirements with risk management. Balancing social obligation and business constraint. A nuanced view recognizes that PSL is both a social obligation and a business constraint. Effective management involves strategic approaches, innovative product design, microfinance, crop loans, and MSME loans packaged with insurance, digital tracking, and flexible repayment schedules. Risk mitigation, use of collateral substitutes, credit guarantee schemes, and government-backed insurance, that is CGTMC or MSMH. Technology integration, digital lending platforms, credit scoring models, and EQS reduce operational costs. PSL siege and securitization. Banks can sell excess PSL to other banks, converting social responsibility into a marketable asset. Capacity building, staff training on rural lending, SHG engagement, and MSME financing. Regulatory innovations. RBI allows innovative financing options under PSL, including renewable energy, affordable housing, and export credit. Sublimits for small borrowers encourage inclusive lending without significantly affecting banks' profitability. Key debates on PSL. Social obligation versus profitability. Critics argue that PSL forces banks to subsidize social objectives at the cost of profitability. Supporters counter that long-term socio-economic development indirectly benefits banks through expanded markets, financial stability, and lower systematic risk. PSL and risk-weighted assets. Loans under PSL are often less collateralized, increasing the risk weight and impacting capital adequacy ratio. Banks need sophisticated risk management practices to avoid overexposure. Performance metrics. Compliance versus outcome. Meeting PSL targets is one metric, but evaluating social impact is equally important. Some banks adopt impact assessment frameworks to measure real benefits, not just loan disbursement. Emerging areas. Green PSL, renewable energy, energy efficiency, and climate friendly projects. Digital PSL, using technology for financial inclusion, that is digital microloans. Inclusive credits, loans for minority entrepreneurs, women led startups, and social infrastructure projects. Advantages and challenges summary. Aspect purpose. Advantages social obligation, inclusive growth, equitable access. Challenges business constant, compliance burden, less profit. Sector impact. Advantages agriculture, MSME, education, housing. Challenges high default risk, small ticket loans. Regulatory aspect. Advantages structured targets, sublimits, PSLVs. Challenges reduced flexibility in fund allocation. Operational aspect empowerment of weaker sections. Advantage challenges high monitoring, operational cost. Long term aspect advantages expense market, social stability. Challenges potential impact on NPAs and profitability. Conclusion. Private sector lending is neither purely a social obligation nor purely a business constraint. It embodies a delicate balance between developmental responsibility and financial prudence. From a social perspective, PSL is essential for financial inclusion, poverty alleviation, rural development, and social equity. From a business perspective, PSL presents challenges such as lower profitability, higher operational burden, and credit risks, which require careful management. Thank you very much for your patience. Request for like, subscribe, and share.